Fidelity National Financial, Q2 2026. They actually beat consensus estimates. Adjusted EPS came in at $1.39, which beat the $1.35 forecast.
Right.
So that's a 4-cent or like 2.96% surprise, a really solid rebound from their Q1 miss. And on the top line, total revenue hit $4.05 billion.
Which is huge. That surpassed the $3.86 billion estimate by almost 5%.
Yeah, exactly. But then we hit the forward guidance. Management expects a modest pre-tax title margin compression in the second half of 2026.
Right. They cited recruiting and tuck-in acquisitions for that.
Exactly. And they're projecting $95 million to $100 million in quarterly interest and investment income going forward.
Which basically triggered total whiplash in the market. I mean, shares surged 2.82% to $52.54 the day of the earnings call just on that headline beat.
Naturally.
But then by the very next day, shares plunged 4.49% in after-hours and regular trading. They closed at $50.18.
Wow.
Yeah, completely wiped out the gains once the market actually digested that margin compression guidance and, the lower alternative investment yields.
So for you listening right now, you might be looking at your portfolio or just watching the ticker and wondering, how exactly does a solid revenue and EPS beat result in a brutal stock sell-off like 24 hours later?
It's a great question.
And that is the mission of this deep dive. We are going to unpack the underlying segment data to explain this exact market reaction.
Yeah, and to understand the psychology behind that initial stock surge on earnings day, before the drop, we really have to look directly at the main driver of their top-line beat.
Right, the title segment.
Exactly, FNF's title segment. This is their traditional revenue engine, and the numbers here were just undeniably strong.
Yeah.
Adjusted pre-tax earnings for the title segment soared 33% year over year to $448 million.
I mean, to see a 33% earnings spike in a core business is massive. But looking at the breakdown, what stands out even more to me is the profitability.
Oh, absolutely.
The adjusted pre-tax title margin actually expanded by 230 basis points to this industry-leading 17.8%. Getting anywhere near an 18% margin in title insurance is phenomenal.
It really is.
Especially considering the current macroeconomic environment, right?
Yeah, the broader environment makes that margin expansion look almost counterintuitive.
Yeah.
We know the residential housing market is essentially frozen because of elevated mortgage rates.
Right. Existing home sales are sitting at historically low levels.
Exactly. They did see daily purchase orders opened creep up like 3% year over year, and refinance orders were up double digits compared to last year. But overall, residential volume is just moving at a crawl.
Which means residential real estate simply cannot be the engine driving a 33% earnings jump.
No, not at all.
So that points us directly to the commercial real estate side of the house, which was just the absolute standout of this report.
Yeah, the numbers there were wild.
Direct commercial revenue hit $778 million in the first half of 2026. That's up 24% year over year. And it's driven heavily by strength in industrial properties, data centers, and multifamily housing.
And the mechanism behind that commercial surge is fascinating. While individual home buyers are priced out by, 7% mortgages, institutional capital is just flooding into logistics and AI infrastructure.
Right.
A single data center transaction carries a massive valuation, complex zoning requirements, and consequently, an enormous title insurance premium.
Makes sense.
So FNF is capturing these massive high-dollar commercial transactions while the low-dollar residential market basically sleeps.
Right. So if you think about their business like a car, commercial title fees are basically acting like heavy-duty shock absorbers.
I like that analogy.
Yeah. One massive commercial deal brings in enough cash to cover the overhead of dozens of missing residential deals, carrying them over this, pothole-filled residential road.
Exactly.
But I do have to push back on this setup a bit.
Okay, go for it.
If the residential market is sitting at historic transaction lows, isn't FNF dangerously overexposed if the commercial sector, which seems to be their only real growth engine right now, inevitably cools down?
Well, that is a primary concern for institutional analysts tracking the stock. The fear is that commercial real estate is cyclical too, right?
Right.
And if data center builds slow down, FNF loses its current shield.
Right.
But if you look at the operational data, they aren't just relying on high commercial premiums to save them.
What else are they doing?
They've fundamentally restructured their cost baseline. They have been aggressively investing in a digital workflow platform called inHere.
Oh, right. And the adoption numbers on that platform are huge. It's now engaging, what, 80% of their residential sales transactions?
Yeah, 80%.
Really?
And by processing that much digitally, they drastically reduce the manual labor required to clear a title, coordinate physical signatures, manage escrow, all of that.
Right.
So the 17.8% margin is protected because the baseline operational cost to execute a single transaction is leaner than it has ever been.
So they've essentially built an engine that runs smoothly on low fuel. The
Exactly.
margin isn't just a byproduct of high revenue commercial deals, it's a byproduct of stripping the friction out of the entire process. So when residential volume eventually thaws and returns to normal levels, that digital infrastructure is already in place to handle the scale without a proportional increase in headcount or overhead.
Yeah, taking that a step further, it means every incremental residential deal that comes back online in the future will drop more profit straight to the bottom line than it did in previous cycles.
Wow, so they just keep more of the money.
Right. They're capturing a larger share of the profit pool simply by being the most technologically efficient operator in the room.
Okay, so if the title segment is this incredibly efficient shock absorber keeping the ride smooth, FNF should have been soaring on Wall Street all week.
You think so?
But, as we noted in the open, they dropped almost 5% the next day. That implies there is some heavy cargo in the trunk weighing the whole vehicle down,
And there is.
which points squarely at their annuities and life insurance business, F&G.
Exactly. If the title segment was the catalyst for the initial headline surge, F&G is the primary reason the market reassessed the math and sold off the stock.
Right. Now, looking at the top-line metrics for F&G, the growth actually looks solid on paper, right?
Really does.
They achieved record assets under management, or AUM, before reinsurance of $74.7 billion. That's up 8% year over year.
Yeah.
Retained AUM is sitting at $55.9 billion. Their gross sales were very strong at $2.7 billion for the quarter.
And core retail sales had one of their strongest quarters on record, actually.
Oh, wow.
Yeah, even while the broader industry saw a fixed indexed annuity sales contract by like 5% in the first half of the year.
So the sales team at F&G is clearly executing and capturing market share against their competitors.
Definitely.
But the fundamental problem is that top-line growth completely failed to translate to the bottom line in this specific quarter.
Yeah, the bottom fell out. Adjusted net earnings for F&G fell to $65 million.
Down sharply from $89 million in the second quarter of 2025.
Right. A drop from $89 million to $65 million is significant.
It's massive. So unpacking that decline, it looks like there are two distinct factors dragging down those earnings,
Right. The first one is a purely mechanical accounting reality.
which is FNF's ownership stake in F&G decreasing, right?
Exactly. It dropped from roughly 82% a year ago to about 72% currently, following a stock distribution at year-end.
So that smaller ownership slice mechanically shrinks FNF's reported earnings on paper. They simply own less of the pie, so they claim fewer of the profits.
Right. But an ownership change doesn't explain a massive stock drop. Wall Street analysts build that basic math into their models months in advance.
Yeah, that shouldn't be a surprise.
No. The market had to be spooked by the underlying performance of the assets themselves. Which brings us to the second factor, the alternative investment portfolio.
The performance of those alternative investments is what really triggered the alarm bells.
Big time. The alternative investment income drastically underperformed, bringing in only $35 million for the quarter.
Wow.
To put that in perspective, that translates to a yield of roughly 7 to 8%.
Which is way below management's long-term expectation of a 12% yield. And it's down significantly from the $55 million that same portfolio generated in the same quarter last year.
Huge drop.
Plus, we see that earnings were further diluted by the sale of F&G Life Free in Bermuda back in March.
Right.
So you have this alternative investment portfolio acting like a star athlete who suddenly forgot how to shoot in the playoffs, just dragging down the overall score for the entire company.
That's a great way to put it.
But it makes me wonder, why does a high-margin, hyper-efficient title company keep a capital-intensive annuity business around in the first place? Especially if it dilutes their earnings and creates this much volatility on the balance sheet.
Well, that question is literally at the core of the debate among institutional investors right now. Combining a cyclical, cash-generating title business with a capital-intensive life insurance business is an unusual pairing.
Yeah.
The strategic answer lies in how F&G's management, led by CEO Connor Murphy, is currently trying to reshape the underlying business model.
What are they doing?
They are actively attempting to shift F&G toward a more fee-based, higher margin, and less capital-intensive model.
So they're trying to act less like a traditional bank holding all the risk and more like a toll booth collecting fees.
Exactly.
What's the actual mechanism they're using to achieve that shift, though?
The primary mechanism is a heavy reliance on flow reinsurance and distribution margins. In a traditional model, an annuity company takes a customer's premium, holds all that capital risk on their own balance sheet, and tries to invest it to generate a yield higher than what they promised the customer.
Right.
With flow reinsurance, F&G takes the customer's premium, but immediately passes portions of that underlying risk off to a third-party reinsurance partner.
Oh, I see. So by ceding that risk to a partner, F&G acts more like an originator.
Exactly.
They still collect fees for sourcing the customer and managing the distribution channel, but they tie up significantly less of their own capital.
Right. And the volatility we're seeing right now, specifically the drag from the alternative investment, misrepresents the growing pains of a business caught in the middle of a transition.
Gotcha.
They're still holding a massive amount of legacy assets on their balance sheet that are vulnerable to underperformance while actively trying to transition future business to this lighter, fee-driven flow reinsurance model.
So the long-term thesis is that once this shift is complete, it'll stabilize earnings and provide a steady, predictable, counter-cyclical cash flow that balances out the volatile housing market exposure of the title business.
That's the dream.
But right now, Wall Street has zero patience for growing pains.
None whatsoever.
Yes.
Which brings the entire narrative to a head regarding how management is handling the tension between the highly profitable title business and the transitioning F&G business.
Right.
Ultimately, the segment data explains the mechanics of the quarter, but it was management's commentary on capital allocation and their forward guidance that truly forced the market to sell off the stock.
It's a classic story of how a company chooses to deploy its cash today versus how Wall Street demands they deploy it.
Exactly.
So let's look at the actual capital return numbers first, because on the surface, they look incredibly shareholder-friendly. In Q2, FNF returned $195 million to shareholders.
Right.
That breaks down to $138 million in dividends and $57 million in share repurchases.
But the tone completely shifted during the earnings call when FNF CEO Mike Nolan and F&G CEO Connor Murphy addressed those buybacks.
Right. They explicitly told investors that the share repurchases were purely opportunistic. It is not a standing policy.
Right.
And they warned investors not to assume that this pace of buybacks will continue going forward.
Which is a huge deal. When executive management deliberately steps back from a commitment to buy back shares, it removes a perceived psychological floor under the stock price.
Oh, for sure.
Traders rely on corporate buybacks to absorb selling pressure. When management says they might turn that buying machine off, algorithmic trading models often immediately reprice the stock lower to account for the added risk.
And the buyback commentary was just the first warning sign. The primary risk that seemed to really drag the stock down into negative territory was management's forward guidance on the title segment itself.
Yeah.
Because despite that incredible 17.8% margin we just discussed, they're actively forecasting pre-tax title margin compression in the second half of 2026.
Right, and margin compression is just a technical way of saying it's going to cost them more money to generate $1 of profit over the next 6 months.
So we have to analyze the specific driver behind that forecasted margin compression. Management made it clear that they do not expect margins to compress because they're losing pricing power or because the in-here platform is failing.
Right.
The margin compression is entirely self-inflicted. They are deliberately front-loading expenses by accelerating tuck-in acquisitions and heavily recruiting new agents and talent.
And just to clarify, a tuck-in acquisition in this context means they are going out and buying smaller, struggling local title shops and absorbing them directly into the FNF infrastructure. They're paying the upfront acquisition costs and the recruiting bonuses right now, well before those new assets and new hires can actually generate meaningful revenue.
Which obviously pinches the profit margin in the short term.
Exactly.
Analysts had a very mixed reaction to this strategy. Barclays, for instance, maintained an equal weight rating on the stock, but they actually raised their price target from $51 to $54.
Oh, wow.
Yeah, they specifically noted that their model balances the incredibly strong execution in the title segment against the F&G earnings drag and this new margin compression guidance.
That equal weight rating from Barclays is a very measured view.
Yeah.
It indicates that they recognize the fundamental operational strength of the core business, even if the near-term financial optics look a bit messy due to the front-loaded spending.
Right. But I want to zero in on the logic behind that opportunistic buyback commentary because this is where the math doesn't quite add up for me on a surface level.
Okay.
The stock is currently trading around $50, which is well below the mean analyst price target of $61.40. If management is simultaneously stepping back from buybacks while the stock is arguably discounted, does that imply FNF's own executives actually share Wall Street's bearishness about this impending second half margin compression?
I see what you mean.
Like, if they truly believed the stock was cheap, wouldn't they use their capital to keep buying it up?
Well, this highlights a fundamental disconnect between how executive leadership teams view capital allocation and how short-term traders view it.
How so?
Management stepping back from buybacks doesn't necessarily mean they are bearish on their own company's long-term value. Rather, they are playing a much longer strategic game based on the macroeconomic realities of their industry.
So if they aren't using the cash to prop up their own stock price, they must believe they can get a significantly higher return on that capital elsewhere.
Exactly.
How are they deploying it?
Think back to the broader real estate environment we discussed earlier. The residential market is effectively frozen. Transaction volumes are sitting at historic lows.
Right.
In that specific environment, smaller independent title agencies are starving for revenue. They do not have the massive commercial real estate shock absorbers that FNF has.
No, they definitely don't.
And they don't have the scale or the cost savings of the in-here digital platform. FNF's management looks at the current landscape and basically sees blood in the water.
So they are hoarding their cash to go on the offensive.
Yes. They are entirely willing to sacrifice their short-term profit margins in the second half of 2026 to aggressively recruit top talent and acquire vulnerable competitors right now.
Wow.
A dollar spent on a stock buyback at $50 might yield a decent, safe return for shareholders today. But a dollar spent acquiring a struggling competitor's market share at the absolute bottom of a housing cycle.
That yields an exponential return when the macroeconomic cycle eventually turns.
Exactly. They are building capacity and market dominance so that when the Federal Reserve finally drops mortgage rates and residential volume floods back into the market, FNF is the undisputed giant in the room.
Ready to process all of it through their high-margin digital platform?
You got it. Wall Street sold the stock because institutional traders hate short-term margin compression and unpredictable buybacks. But management accepts the compression because they want to win the next decade of the housing cycle.
Wow. It requires a strong stomach from their shareholder base to endure the short-term volatility.
It really does. But historically, this is exactly how market leaders consolidate their power during industry downturns. They weaponize their balance sheet when their competitors are weakest.
That entirely reframes how we should look at that margin compression guidance. It isn't a leak in the boat, it's the deliberate cost of building a much bigger engine while the rest of the fleet is stranded.
Exactly.
Well, if you want to keep tracking how this aggressive expansion strategy plays out in future quarters, make sure you follow the show and join us for the next deep dive into daily earnings coverage.
And as we wrap up, I just want to leave you with a final thought to consider. Circling back to that incredibly high 17.8% margin in the title segment. Given FNF's massive investments in workflow technology like the in-here platform, their increasing focus on artificial intelligence for fraud prevention, and this aggressive second-half recruiting push, could we be approaching a future where technology completely decouples the title insurance industry's profit margins from the physical housing cycle? Or, despite all this digital innovation, will title insurers ultimately always remain hostages to the Federal Reserve's interest rate decisions? Something to mull over as you watch this sector evolve.